Hey guys, welcome back. So I know it's been a while since I've been putting up videos, and I'm just going to apologize right off the bat for that, but at the same point in time, I am a college student wrapping up college here. I've just started another company and we just won our first round of fundraising. And it's been a bit hectic over the past couple of months for me between classes, starting a business, learning all the new stuff I have about finance, and really figuring out on going for like my CFA in a couple months. It's been a hectic month, but you know what? I'm back, and now I have a lot of new material. I think that is going to be very useful for all of you that watch this channel. And I'm going to kind of be gutting this channel and starting from the ground up on how I go about, stock valuations, introductory, financial topics, so that way people at home that haven't gotten, say, a degree in finance can kind of follow along and be one step better than, their peers that also haven't gotten finance degrees in the whole, money situation. So that's kind of the direction this channel is going to be going in. I'm still going to be doing individual stock analysis. I will be putting up some videos in the future once I get the okay from my team about how we have gone about creating a business and, kind of all that stuff. But without further ado, that's just kind of why I haven't been putting up videos recently, and I apologize for that. But now I'm getting another corporate job in a couple of months, and now I'm off from school. So I have a lot more free time to put out more content. So without further ado, let's get in the video. So bringing this to the very beginning, you essentially have two types of things that you can look at in your individual life. You can either acquire assets or you can acquire liabilities. Now, I'm not going to be spending too much time on liabilities here on this particular video, but I can do a video for it in the future. But assets are essentially anything that you buy with money now with the plan of having more money later. That is essentially why you would ever buy an asset, whether it's, say, cash, a business, cryptocurrency, gold, real estate, anything like that. You expect that if you put money in place now, when you go to take out your money in the future, you'll have more money. That is essentially what an asset boils down to. However, not all assets are created equally, and not all assets can be valued the same way. And so in this video, I'm going to be breaking down exactly the two main camps of assets and how you go about dealing with them and what area of assets I will be sticking in, for the foreseeable future. Now, the two main asset camps are assets that either are non-cash producing assets or assets that are cash producing. Now, the way that you can kind of think about this is that if you can take a non-cash producing asset such as gold or Bitcoin, that is an asset that you're buying in and that you expect, okay, you want the price to go up, but there is no cash flow coming in from that asset. So you realistically don't have any way to value it other than the fact that in the future you believe it's going to be worth more or worth less, and thus you trade it accordingly. When you switch over to cash producing assets such as stocks, bonds, and businesses and other things like that, like say investment, real estate, you essentially have a cash flow that you're able to discount back to all your future cash flows that you're able to discount back to your present day value, and you're able to come up with a price and a value for that stock or company or business, whatever it is. Now, when you have these two types of camps, you essentially have price and value, and that is where the key differentiator for these two assets are. So when you have a non-cash producing asset, because there is real no thing that you can discount back to exactly saying like, okay, this is valued at this right now, this is going to produce me X amount of dollars in the future, so I'm willing to pay this amount of money for it right now. Because you don't have that, any price that you pay for Bitcoin, gold, silver, oil, anything like that, while they do have some uses outside of just trading it, realistically what you pay is the value. There's no real theory as to why that value should be different than price. Now, yes, obviously, with silver, for example, we do hit a floor, and that it has a demand, and when it hits that floor, that should be its minimum value. However, there is no real intrinsic reason as to why that piece of silver or gold, if you just buy it and now put it in a locker and you come back from 20 years, it's not going to be producing you anything, so it's going to exactly be the same piece that you left it, and whatever that price is or whatever the market is going to decide at that point in time. Now, when you step over to cash producing things, you have a situation where price does not equal value. And as individual investors, we are supposed to figure out, okay, the price that the market is giving us and the value that we are calculating, how do they match up? Is the price higher than the value? In that case, we would either sell or stay away from it, or the value that we calculate is above the price that the market is selling it for us, and that is when we know that, say, a stock or anything like that is a buy. And now, so in the rest of this video, I'm going to be focusing on the tried and true ways of valuing a, say, stock or anything like that, figuring out its value and comparing it to the price that the market is giving you in order to figure out whether or not a stock is a buy. Now, this is going to be a relatively high-level view, but I'm going to be giving you the skeleton to be doing this, and this is the same way that the pros use. Any type of fundamental analysis will result back to these 4 methods that I'm going to be going over. And using those methods, you'll be able to figure out whether or not a stock is a buy or not based off of your opinion of their value. All right, so here are the 4 main models that are used in fundamental stock analysis, and anything that, say when an individual, say a fund manager or an individual retail investor is looking at a company and they're expecting to actually get a real value for it, they're essentially trying to figure out what is the current value of all of their future cash flows, or what is the current value of this company in retrospect to its competitors. Now, these 4 models, or skeletons you can call, are essentially different ways that, large investors to retail investors attempt to discount any type of cash flow that they're going to be receiving from an individual business, stock, bond, or anything like that, in order to figure out what is the current present day value and how much are they willing to pay for that price versus what the actual market is asking for that price. And so starting at the top, you have the dividend discount model, which is probably the weakest of all of the models covered here. The dividend discount model is essentially looking at every dividend that you're going to be coming into over the next, say, 10, 20, 30 years. And you're going to be looking at, okay, what kind of growth am I expecting to gain from that, whether it's flat, accelerated, 2-part, whatever. And you're going to be taking all of those cash flows at once and discounting them back to present day to figure out, okay, say I'm going to be getting $400 over the next 20 years from this investment. Okay, assuming my, expected rate of return is 15, I'm going to discount all of those back by 15 to whatever year it is and figure out, okay, what is the raw value that I would pay for now to get $500 in the future. So definitely the weakest strategy, because you have a lot of assumptions of constant growth, and if you look at any company paying a dividend, whether it's a dividend aristocrat or a company that goes off and on and paying a dividend, figuring out exactly how they're going to be paying that dividend and exactly what growth they're going to be doing that at is extremely difficult, because it's almost never linear. So that's why this model is probably the weakest out of them all. So now the next model that we're going to be looking at is ROPI. Now ROPI is the residual operating income that any business is producing. So it's essentially like after you convert a standard balance sheet or income statement into a financial balance sheet and income statement, you're essentially going to be figuring out, okay, how much revenue is being pulled in, and then what is the residual income that the company is left with at the end of each, say, cycle. Now ROPI, while it is much more accurate than a dividend discount model, you essentially have to kind of go through the weeds of what the accountants do from each individual firm to kind of butter up their numbers and hide things throughout the different income statements. So while, converting a standard accounting type of financial statement that you get from like a 10K or 10Q, and you convert that into a financial one, it's a better viewpoint into the business, but there are just so many things that get lost along the way. It is not the most accurate way to do it unless you have individual businesses that are, they're tried and true. The way that they've been reporting their numbers is the same as it's been for the last 30 years. So, if it's a more robust business that isn't, changing up anything, like say if you look at a McDonald's or anything like that, using ROPI is pretty much fine. But if you're looking at any company that has, massive amounts of growth, or a company that is, say, switching industries or anything like that, definitely ROPI is going to run into some hurdles, and you won't really want to be doing this type of analysis. And now the discounted free cash flow model is by far probably the most accurate. And if you were to, say, ask Warren Buffett what type of evaluation model would he use when valuing a business, he is almost guaranteed to say the discounted free cash flow. The discounted free cash flow is essentially you're gutting everything that's going on in the business, and you essentially just want to see what's happening in the business. How much did they pull in? How much did they pull out? And then what is left with it at the end of the day. Now, this is probably the most accurate out of all 4 of these models to figure out exactly, what is going to be the true value of this company and what can I expect from it regardless of what happens. However, there are still assumptions in this type of model, as in all of them, and that is to say, like, okay, you have to really figure out what type of growth the company is going to be going through. If the revenue is coming in at a very steady rate or a very choppy rate, that is going to drastically impact what type of growth assumptions you give it. But realistically, no one can look into the future. So it's still all kind of up in the air for exactly how strong this model is. And that's why generally when you use any of these top 3 models, you essentially have a bear case, a neutral case, and a bull case. So whether you think a recession is going to hit in the next 4 years, or if you think that everything is just going to kind of be smooth sailing, but nothing's going to really surprise to the upside, you have a neutral target, or a bull case when you think that, okay, the company, due to X amount of projects, is going to have an extremely fast and better performing future than it has in the past. You need to come out with a range of price targets, and then whenever that price falls, say in my opinion on the lower half of it, that is generally when I would like to start a position. However, the discounted free cash flow model is by far probably the most accurate, and that will be the one that in my future stock analysis that I put here on the channel, that I'm going to be primarily focusing on this model and then backing up using research why I'm giving an individual company the growth assumptions I am. Now, skipping all of that and going to by far the easiest way to value a company is the multiples approach or the traders approach. Now, I know a lot of you are going to give me flack saying that why is a multiple approach called a trader's approach? Just because I'm looking at a PE doesn't make me a trader. And that isn't exactly what I'm talking about. The reason why in the financial world you have a multiples approach and it's classified under trading is because all of these things have theory behind it that are pretty much explaining why people are willing to pay X amount of money for, say, a future cash flow of Y. However, the way that people look at it when they look at a multiples approach is that, that requires, putting assumptions on the future that no one can do accurately, regardless of how much money or how much experience they have. So I'm going to ignore all of that, and I'm going to pick random accounting numbers, and based off of those accounting numbers, now the business is, going, whether it's earnings per share, sales per share, free cash flow per share, anything like that. You're essentially picking a random value based off of whatever industry the company's in and assigning it and comparing it to its price, comparing it to its peers, and then comparing where it is to its previous levels. So if you say Apple's trading at a PE of 14, Apple normally trades for a PE of say 16 to 18, and other companies that you think are comparable to Apple are all trading at about a 20. You think Apple is undervalued based off of that, and you buy it accordingly, and then you will sell out of it whenever its PE becomes elevated compared to the rest of the rest of their companies. That is a very, very basic breakdown of the multiples approach, but due to the fact that they kind of disregard a lot of the theory that financial institutions have kind of baked into all of these things, that's why it's more so called as a trader, because you're not interested in the individual business. You just think that this thing is relatively cheap compared to what it's been in the past and its competitors. That is essentially why most multiple approaches get labeled as a trading approach. However, that is not to say that you cannot use that, say, an investor or someone that is trying to play everything by the book and be that intelligent investor that we know about, that they will use a discounted free cash flow, but they will say, like, in their screening, they will look for companies with particular lower multiples and things like that because they think that they're being mispriced by the market. The way that my professor explained it to me was great. He said that the PE ratio, the most important ratio, say, in all of finance, is essentially, rather than doing anything to indicate, how well the business is running or how well it's not, is essentially a how much people like it test. The higher the PE, there's really no justification for why a company would have a high or low PE except of the individual's opinion on the company. So if you have a company that's trading at a PE of 40, that is just in an industry or it's a booming company that people prefer more than, say, a company that has a PE of 12. There's really no reason as to why something should have a multiple of X or should have a multiple of Y. And that's why a lot of the models that people make, that is, okay, well, based off of their future cash flows and then giving them this multiple, there's a lot to be up for grabs there because, for the car industry, for example, standard multiple is about a 6. Why is it a 6? There's no real reason why the PE should be a 6, but that's just what everybody else is doing, so you're basing your end conclusion off of what the market's telling you. When you have the you have the discounted cash flow, you essentially get a raw dollar value that is exactly what the price should be. So that's kind of up in the air. Like, I personally do use multiples, but now I'm using multiples to kind of test the waters and figure out, okay, what stocks do I want to look at? And then I look at the discounted free cash flow to really figure out what I'm dealing with. And all of these are going to be different use cases for different type of industries. But for the companies that I'm really focusing on, these two are the approaches that I use. So that's essentially it for a very rough, high-level view of all the main models that are used in financial analysis. And so hopefully you guys got some use out of that. And I will be doing individual videos on each of these models, so that way you can really dig deep into how to apply each of them to your own individual stocks. And you know, if you say only use 1 or 2 of these, you can essentially use all 4. It's just, you know, really dependent on you want to use a dividend discount model on a company like either Starbucks, where the dividend is growing at an astronomical rate, or you know, a company like Google that doesn't pay a dividend. Obviously you can't use this, but you could use ROPI, you could use discounted free cash flow, and you could use the multiple approach. So it really depends on what type of industry you're looking at and what kind of company you're looking at. But all of these 4 models are essentially, getting a mastery of all of them will make your individual stock picking career a significantly easier time. So hopefully you guys got some use out of that. Let me know what you guys think in the comment section down below. And thank you guys if you stuck to the end. Make sure to drop a like and subscribe, and I'll catch you guys in the next video. Peace.